Hello and welcome to Dr. Rachel's classroom. In this video, we will be discussing a couple of problems under the marginal costing topic. Uh, we will be discussing problems that can be worked out in the traditional as well as the contribution format. We'll also be discussing the difference between absorption costing and marginal costing. So let's dive right into the topic. So marginal costing, it's basically a technique of costing fully oriented towards managerial decision making and control. It being a technique that can be used in conjunction with any method of cost ascertainment. It is also used in combination with other techniques such as budgeting and standard costing. We will be using marginal costing to determine the profitability of products, departments, processes, and cost centers. So while we analyze the profitability, marginal costing interprets the cost on the basis of nature of cost. So here, under this concept, the emphasis is on the behavior of the costs and their impact on profitability. So marginal costing basically involves one, ascertainment of marginal cost, and two, deriving of cost volume profit relationship by differentiating between fixed costs and variable costs. So let's see a problem under marginal costing. We will be trying to determine the profit on using two formats. One using the traditional format and the other using the contribution format. So in marginal costing, the difference between the sales and the variable cost is called contribution. Contribution from all the cost units or centers is set off against the fixed cost to ascertain the profit. So that's what contribution is basically about. So we're going to see how to determine the profit using traditional format as well as the contribution format. So let's look at the data that is given to us. We have sales 84 lakhs, depreciation, supervisory salaries and other fixed costs 18 lakhs, variable production cost 22 lakhs, operating expenses, administration and selling expenses are also given. We have to note that 50% of the administration expenses and 40% of the selling expenses are fixed, which means that 50% of the administrative expense is variable and 60% of the selling expenses is variable. So we have 16 lakhs of administration expenses. Of this, 50% is fixed. So 8 lakhs is fixed, 8 lakhs is variable. And selling expenses is 20 lakhs, of which 40% is fixed. So 40% of 2 lakhs is 8 lakhs. 8 lakhs of selling expense is fixed and 60% of 20 lakhs, which is 12 lakhs of the selling expense is variable. Alright. So first let's go through the contribution format. Alright. So contribution format, we will first determine the contribution, that is sales minus the variable cost. We will determine the contribution, and from the contribution we deduct the fixed cost to determine the profit. So sales we have already it's already given, which is 84 lakhs. Variable cost, variable production cost 22 lakhs, and 50% of administrative expenses and 60% of selling expenses is variable cost. So 50% of administrative expense 8 lakhs and 60% of 20 lakhs is 12 lakhs. So 22 lakhs, 8 lakhs, 12 lakhs will give you 42 lakhs. So sales minus variable cost together, put together, contribution is 42 lakhs. And fixed cost again, depreciation, supervisory salaries and other fixed costs amounting to 18 lakhs. 50% of administrative expenses and 40% of selling expenses is fixed. So you add it together and you deduct it from the contribution, you get your profit. Traditionally, we will determine the cost of sales, cost of production, and deduct it from the sales value to determine the profit. So cost of production inclusive of all the costs, that is the cost of producing a product, cost of production, all of that will be added together. Cost of producing the product, all the costs involving the production of the product will be added together, plus the selling expenses will give you the cost of sales. So sales minus cost of sales will give you the profit. Let's see one more example before we see how to determine the profit. Let's see the difference between marginal costing and absorption costing. So under absorption costing, all the charges, all costs, it charges all costs, both fixed and variable, to the products, jobs, processes, operations, whereas marginal costing technique charges only variable cost. Another difference is that absorption costing is not any specific method of costing. It is just another name, a common name for all the methods where total cost is charged to the output. So let's see how to determine profit under the marginal costing method and absorption costing. Here in this problem they have given us details for 2 years. Okay, so the factory has an installed capacity of 10,000 units. Opening inventory is given for 1992 and closing inventory is given for 1991. Output under each year is 10,000 units and 9,000. Sales is 9,000 and 10,000 units. Fixed cost for the year is 85,000. Selling price per unit is 14 rupees and variable cost per unit is rupees 2.90. So under the absorption cost, where under this method we are charging all the costs, both fixed and variable together we will be charging. Okay, so we will be basically determining the cost of sales and deducting it from the sales put together and determine the profit. So we know that sales, they have given 14 rupees and the number of units sold for the year 1991 is 9,000. So 9,000 into 14 is 1,26,000 and 10,000 units into 14 is 1,40,000. Minus the cost. First we have to determine the variable cost. So the variable cost they have given is 2.90. So 2.90 into 10,000 units and 9,000 units respectively, we determine it as 29,000 and 26,100. Fixed cost is also given 85,000 under each year. So put together you will deduct it from the sales, you get the cost of, you don't deduct it right now, you first add the cost. 1,14,000. Right now you don't deduct it from the sales. You will first determine the cost of sales and then you subtract it from the sales. Plus opening stock. Opening stock for 1991 is not given, but it is given for 92. So opening stock for 1992 is 1000 units. This 8.5 is your fixed cost divided by 10,000 units. So that's how you have arrived at 8.5 plus 2.9 is your variable cost. It's given in the question. So both put together, you multiply it with 1000 units, you get 11,400. And closing stock, you deduct the closing stock. You add the closing stock and you add the opening stock and you deduct the closing stock. Same way, closing stock is also 1000 units. 1000 units into 8.5 plus 2.9, you get 11,400. So you deduct it from the cost of production and you arrive at cost of sales for 1991 and 92. So sales minus cost of sales, you get profit. Profit under the absorption costing is 23,400 for 1991 and 17,500 for 1992. If you take the marginal costing, where we are going to determine contribution. Contribution is arrived by finding the difference between sales and variable costs. So sales, we've already seen how to determine that. Number of units into the sales price minus variable cost. In the variable cost, we will be including the opening stock and the closing stock. Since it is only variable cost, we are determining the opening stock value as 1000 into 2.9. Okay, we are not taking the 8.5 into account because it is fixed cost. So we are determining the total variable cost, and the total variable cost is deducted from the sales to arrive at contribution. Once you determine the contribution, you deduct the fixed cost, which is 85,000 for each year, and you arrive at the profit. If you see, there is abnormality in the results disclosed. This is because of the reason that absorption costing, there is abnormality in the results disclosed by the absorption costing, is that the portion of the fixed cost of 1991 is carried forward to 1992 as a part of their closing stock here. Okay, so therefore it is inflating the 1991 profits, and to the same extent it is decreasing the profit of 1992. So hence this is the reason for the abnormality in the results disclosed. Thank you.